gold is making new highs, silver is breaking records, and Bitcoin is under pressure. For some, this feels unsettling. For others, it feels like confirmation of long-held doubts. If Bitcoin really is digital gold, why does it fall when uncertainty rises? Why does it behave like a risk asset precisely when trust in the system seems weakest? The answer isn't emotional, and it isn't ideological, it's structural. Because markets don't move on narratives. They move on liquidity, incentives, and time horizons. And right now, most people are looking at Bitcoin through the wrong lens. If you'd rather understand markets than react to headlines, hit subscribe and join the sharp side. Now let's slow this down properly. Risk-off doesn't mean panic, and it doesn't mean collapse. Risk-off means uncertainty has become more expensive. When political, fiscal, and monetary signals conflict, capital does what it has always done. It simplifies. Funds reduce exposure. Leverage comes down. Liquidity becomes king. In those moments, assets aren't judged by their philosophy, they're judged by their function. Gold performs well in these phases because it is slow, inert, and unleveraged. Bitcoin, by contrast, is fast, global, and extremely liquid. That makes it powerful, but it also makes it vulnerable in risk-off phases. This isn't a failure of Bitcoin, it's a feature of how modern markets work. There's a common misunderstanding among investors. When an asset is sold, people assume it's because confidence is lost. But in professional markets, selling is rarely emotional, it's mechanical. Bitcoin is often sold not because it's doubted, but because it solves a problem instantly. Margin calls, redemptions, risk limits. Bitcoin can be converted into cash faster than almost anything else. That makes it a liquidity tool, especially in institutional portfolios. Markets don't sell what they hate, they sell what works. Bitcoin being treated as a risk asset is not a permanent label. It's a situational role. In environments of rising liquidity, Bitcoin behaves like a growth asset. In environments of tightening liquidity, it behaves like a funding source. This duality honestly confuses many observers, but it really shouldn't, because Bitcoin is still transitioning from speculative asset to monetary asset. That transition is not linear, and well, it never was. The phrase digital gold is both helpful and misleading. Helpful because it explains scarcity. Misleading because it suggests immediacy. Gold did not become a safe haven because it performed well in crises. It became a safe haven because it survived centuries of them. Bitcoin has survived wars, pandemics, bank failures, capital controls, and regulatory hostility. But it hasn't yet survived time. That doesn't weaken the thesis. It actually defines the journey. Digital gold is not about short-term correlation, it's about long-term endurance. The current weakness in Bitcoin is driven by external stress. US political deadlock reduces liquidity. Trade tensions increase uncertainty. Bond market volatility raises funding costs. None of these target Bitcoin. They affect everything. Bitcoin simply reacts faster. And because Bitcoin trades globally 24 hours a day, it often becomes the messenger, but the messenger is not the cause. Japan deserves special attention. For years, cheap yen liquidity fed global risk appetite. When that mechanism destabilizes, positions unwind. Not selectively, systemically. Bitcoin gets sold not because it underperformed, but because it was part of the liquidity chain. This is not bearish for Bitcoin's future. It's evidence of its integration into global finance. Bitcoin is no longer outside the system. It reacts with it until it doesn't. This is where clarity emerges. Short-time horizon. Bitcoin is volatile, liquid, and sensitive to macro stress. Long-time horizon. Bitcoin is scarce, sovereign, and politically neutral. Both are true, and, confusing them leads to bad decisions. Markets reward patience, not predictions. Fear compresses expectations. When markets feel heavy, people assume recovery will be slow. Bitcoin historically proves the opposite. When liquidity returns, Bitcoin doesn't wait for permission. It reprices, not because sentiment changes, but because structure demands it. That asymmetry is what long-term holders understand. If you're watching Bitcoin tick by tick, this phase feels uncomfortable. If you're watching history unfold, it feels familiar. Bitcoin isn't weak, it's early, and markets are simply reminding us that time matters more than noise. Stay calm, stay rational, and I'll see you on the next block.